Let me show you something that made my hands shake when I found it. February 7th, 2024. Jeff Bezos filed a Form 4 with the SEC. He was selling Amazon stock. Not unusual, except for the timing and the volume. Over the next 2 weeks, he sold 50 million shares. $8.5 billion in cash. The media barely covered it. A few business outlets mentioned it in passing. Tax planning, they said. He moved to Miami. But here's what they didn't tell you. Michael Dell did the exact same thing in March. After holding for 3 years, he dumped 25 million Dell shares, $750 million. Mark Zuckerberg sold $1.59 billion worth of Meta stock in the first quarter alone. Jamie Dimon, CEO of JP Morgan for 20 years, never sold a share, unloaded $142 million in 2024. Then another $234 million in February 2025. You might think that's coincidence. Rich people cashing out. But when you line up the dates, when you track the pattern, when you see who is selling and when, it stops looking random. These aren't people diversifying. These are people who built the companies that run the modern economy. And they're heading for the exits. I'm Malcolm. This is History Meets Economics. And if you're here, thank you for subscribing. Here's the data that reveals everything. Insider sell to buy ratios. In June 2025, across the entire U.S. market, insiders sold at a ratio of 0.29. For every insider buy, there were more than 3 sells. The long-term average is 0.42. It's dropped 12% compared to last year. For mega trades over $5 million, there were 10 times more sells than buys. The people with access to quarterly earnings before they're published, the people sitting in boardrooms when expansion plans are discussed, the people who know whether their company can survive a recession, they're not buying. They're selling at levels we haven't seen since 2007. And there's a window. There's always a window. It's the gap between when the smart money exits and when everyone else figures out why. That window is usually 6 to 18 months. We're inside it right now. In my last video, I walked you through something most people never see, how debt destroys empires in 4 predictable stages. Rome did it. Britain did it. And America's doing it right now. We're at the point where the government can't pay its debts without printing money or debasing the currency. If you haven't watched that yet, go back and watch it. Because what I'm about to show you only makes sense if you understand where we are in the cycle. This isn't theory. This is what's already happening. And more importantly, this is what you can do about it. Every collapse creates the same opportunity. You just have to know where to look. And more importantly, you need to understand what people learned the last time this happened. Let me take you to Caracas, Venezuela. 2016. You're standing in a supermarket. Fluorescent lights flickering above aisles that used to be full. Now they're mostly empty. You're holding a cart with 3 items. Rice, chicken, cooking oil. The cashier rings it up. 12,000 bolivars. You hand her a stack of bills. She counts them, slowly, her hands shaking slightly because she knows what's coming. By the time you walk out of the store, that same cart of groceries costs 15,000 bolivars. Prices aren't changing daily. They're changing hourly. This is what hyperinflation looks like up close. It's not abstract. You can smell the fear in the air, people racing through stores, grabbing whatever they can before the next price jump, parents calculating in their heads whether they can afford diapers or formula, but not both. The weight of watching your entire paycheck evaporate in 72 hours sits in your chest like a stone you can't swallow. Now let me tell you what the families who survived did differently. They didn't keep money in bolivars. Not for a second longer than necessary. The moment a paycheck hit, it was converted into dollars, into gold, into anything that couldn't be printed. Some families had relatives abroad who sent remittances in cryptocurrency, Bitcoin, stablecoins like USDT, because wire transfers were slow and expensive, and by the time the money arrived, inflation had eaten 20% of its value. They didn't trust banks. In 2018, Venezuela's inflation hit 1 million %. People who left savings in bank accounts watched them become worthless. A lifetime of work, gone. The survivors kept cash under mattresses, in false bottom drawers, anywhere but a financial institution that could freeze withdrawals or impose capital controls. And they became obsessed with real assets. Land. Even a small plot outside the city. Because when currency fails, people don't stop needing food. Owning something that produces, whether it's a vegetable garden, chickens, anything tangible, meant survival. Those who had it ate. Those who didn't left the country. By 2024, Venezuela's inflation-adjusted minimum wage was below $10 per month. The vast majority of the population couldn't afford food. But the families who saw it coming, they were already gone. Or they'd positioned themselves in ways that let them survive while everyone around them collapsed. Fast forward to Cyprus, 2013. A different kind of collapse. Not hyperinflation, a bail-in. You're a small business owner. You run a cafe in Limassol. You've got 150,000 euros in the Bank of Cyprus. Your working capital, the money you need to pay suppliers, staff, rent. It's above the insured limit of 100,000 euros, but you're not worried. It's a bank. It's safe. Then on March 16th, you wake up to news that the government has seized 47.5% of all deposits above 100,000 euros. Gone. Converted to equity in a failing bank. Your 150,000 euros is now worth maybe 80,000 euros if you're lucky, and most of it is locked up in shares you can't sell. The CAF closes within 3 months. You can't pay your suppliers. You can't make payroll. The money you thought was liquid, the money you thought was yours, was taken overnight to recapitalize a bank that had gambled on Greek government bonds and lost. Here's what almost nobody talks about. The insiders knew it was coming. Days before the announcement, certain politically connected families transferred millions out of Cypriot banks. A newspaper reported that companies belonging to the family of President Anastasiades moved over $21 million outside of Cyprus just before deposits were blocked. He denied it. But the pattern is clear. The people who lost everything were the ones who trusted the system, the ones who believed that bank deposits were safe, the ones who didn't see the warning signs or didn't know what to do about them even if they did. And here's the kicker. This wasn't a developing country. This was the European Union, a member of the Eurozone. And they seized deposits anyway. Because when governments run out of options, they take what they can reach. And what's easiest to reach is your bank account. The lesson is brutal. The things people thought were bulletproof turned out to be the first target. Government bonds weren't safe in Greece. They got haircut by 50% in 2011. Bank deposits weren't safe in Cyprus. Cash savings weren't safe in Venezuela, Argentina, Zimbabwe. Every single time, what everyone trusted most was the first thing to fail. So let's talk about today's safe havens. I'm not going to tell you what to do. I'm going to lay out the facts, and you decide. Gold. Central banks bought 1,045 tons of gold in 2024. That's the third consecutive year above 1,000 tons. Poland bought 102 tons in 2025 alone, bringing its reserves to 550 tons. Turkey, India, China, they're all buying. In total, central banks have been net buyers of gold for 15 straight years. And according to a 2025 survey, 95% of central banks expect global gold reserves to increase over the next 12 months. That's the highest level of optimism ever recorded. Why? Because gold has no counterparty risk. It can't be printed. It can't be frozen by a government halfway across the world. When the U.S. froze $300 billion in Russian reserves in 2022, every central bank on the planet took note. If your reserves can be seized with a keystroke, they're not really yours. Gold, physically held in your own vaults, is different. But here's the reality. Gold doesn't pay dividends. It doesn't generate cash flow. If you're holding physical gold, you're betting on one thing, that fiat currencies lose value faster than gold's opportunity cost. Historically, that's been true during crises. In normal times, gold underperforms stocks, real estate, productive assets, Bitcoin, and cryptocurrency. In Argentina and Venezuela, millions of people use Bitcoin and stablecoins because their national currencies are worthless. In Nigeria, crypto adoption is second highest globally. Why? Because in countries with hyperinflation or capital controls, crypto is the only way to move money without the government blocking it. But let's be honest, Bitcoin is volatile. It dropped 70% in 2022. It's not a store of value in the traditional sense, it's speculation with a technological backbone. Stablecoins like USDT are pegged to the dollar, which makes them useful for transactions, but if the dollar itself collapses, so does the peg. There's also regulatory risk. Governments can ban exchanges, impose taxes, restrict on-ramps and off-ramps. It's happened in China, India, and it could happen elsewhere. Real estate. Historically, real estate is one of the best hedges against currency debasement. It's a hard asset. It produces rental income. But it's also illiquid. If you need cash in a crisis, you can't sell a house overnight. And property taxes, maintenance, insurance, those costs don't stop. During the 2008 financial crisis, people who were over-leveraged on real estate got wiped out. In a deflationary collapse, real estate values can fall 30%, 40%, 50%. Ask anyone who owned property in Detroit, Phoenix, or Las Vegas in 2009. Foreign currency and offshore accounts. If the dollar loses value, holding euros, Swiss francs, or Singapore dollars could preserve wealth. But currency diversification only works if the other currency is stronger. And every major fiat currency is debasing right now. The euro, the yen, the pound, they're all inflating. It's a race to the bottom. That said, having access to foreign bank accounts, foreign assets, gives you optionality. If capital controls hit the US, if the government says you can't move money out of the country, it's too late to set up offshore accounts. I'm not telling you gold is the answer, or Bitcoin, or real estate. I am not a financial advisor. In fact, nothing in his video should be acted upon without research. But I'm only telling you that every one of these has worked for someone in a collapse and he passed, and every one of them has failed someone else. The key is understanding the trade-offs and positioning accordingly. Now let's talk about what the ultra-wealthy are actually doing. Not what they say in interviews, what they're filing with the SEC. In 2024 and 2025, tech billionaires sold over $16 billion in stock. Bezos, Zuckerberg, Dell, Jamie Dimon, NVIDIA's Jensen Huang, they all exited significant positions. Some of it was scheduled under 10b5-1 trading plans, which are legal. But here's the thing about those plans. You schedule them months in advance, and you have information the public doesn't. You know your company's pipeline. You know if revenue is going to miss. You know if a product launch is going to flop. So you set up a trading plan that lets you sell automatically when the stock hits a certain price, and it looks clean. But it's not random. It's strategic. And it's not just stocks. Look at where the money is going. High net worth individuals are buying farmland. Bill Gates is now the largest private farmland owner in the United States. Why? Because farmland produces food. And food is the one thing people need regardless of what the stock market does. They're buying international real estate, properties in New Zealand, Switzerland, Portugal, Uruguay, places with stable governments, low debt, and geographic distance from major conflict zones. Not because they plan to live there full-time, because they want optionality. If things get bad in the US, they have somewhere to go. They're setting up foreign trusts, offshore LLCs, international bank accounts. Not for tax evasion, most of this is legal and reported. It's for asset protection. Because when governments get desperate, they go after wealth. And if your wealth is entirely within one jurisdiction, you're vulnerable. And they're holding cash, not dollars sitting in a bank account earning 0.5%. But liquidity, access to capital that can be deployed quickly when opportunities emerge. Because here's the secret that nobody talks about. The best time to get rich is during a collapse. When assets are selling for 30 cents on the dollar, the people with liquidity buy everything. So what should you do? I said I'm not telling you what to do, but I can show you the framework. There are 5 tiers here, based on your access and resources. Tier 1, anyone with $5,000 or more. Start with liquidity. Calculate your monthly expenses. Multiply by 6. That's your emergency fund. If you don't have it, build it fast. Because when confidence breaks, everything freezes. Stocks, bonds, real estate, they all become illiquid. The only thing that's liquid is cash, not in a bank that might impose withdrawal limits. Cash, accessible. Stress test your income. What happens if you lose your job? What happens if your salary gets cut 20%? Can you survive? If not, build a second income stream. Freelance work, side business, something that diversifies your income sources so you're not entirely dependent on one paycheck from one employer. Buy some gold or silver, not as an investment, as insurance. A few ounces of physical metal that you store at home or in a private vault. If the dollar loses half its value, gold historically goes up. If nothing happens, you've got a small insurance policy that costs you nothing but storage. Tier 2, $50,000 to $500,000. Everything from Tier 1, plus foreign currency exposure. Open a brokerage account that lets you hold foreign currencies. Buy euros, Swiss francs, Singapore dollars. Not a huge amount, maybe 10 to 15% of your portfolio. It's a hedge. If the dollar collapses, you've got exposure to other currencies. If the dollar strengthens, you lose a little. That's the trade-off. Consider an international bank account. It's legal. You report it on your taxes. But it gives you access to the global financial system. If capital controls hit the US, if the government restricts outflows, having an account in Singapore or Switzerland means you can still move money. Invest in hard assets that generate income. Rental real estate. Farmland, REITs. Dividend, paying stocks in companies that sell essentials, food, utilities, healthcare, things people need regardless of economic conditions. These assets won't make you rich overnight, but they're resilient. Tier 3, $500,000 to $5 million. Now you're thinking about offshore structures, trusts, LLCs in favorable jurisdictions. This isn't about hiding money. It's about asset protection. If you're a business owner, a professional, someone with significant wealth, you're a target. Lawsuits, government seizures, creditor claims. Structuring your assets internationally creates legal barriers that make it harder for anyone to take everything from you. Buy property abroad, not as a vacation home, as a backup plan. Somewhere stable with a low cost of living, good health care, and a government that respects property rights. Uruguay, Portugal, parts of Latin America. If things go bad in the U.S., you have a place to land. Diversify into alternative assets. Precious metals, yes, but also collectibles, art, rare assets that hold value independent of currency. These markets are less liquid, but they're also less correlated with traditional finance. When stocks crash, people still buy art. People still buy rare coins. It's a different market with different buyers. Tier 4, $5 million to $50 million. You're in the game now. This is where the ultra-wealthy play. You're setting up family offices. You're hiring advisors who specialize in international tax, estate planning, multi-jurisdictional structures. You're buying citizenship in second and third countries, not for the passport, but for the optionality. Malta, Portugal, Caribbean nations, they all have citizenship by investment programs. If the U.S. imposes exit taxes or restricts movement, having a second passport means you can leave. You're investing in private equity, venture capital, direct ownership of businesses, productive assets that generate cash flow independent of public markets. If the stock market crashes, your private holdings don't get marked to market every day. You own part of a company that makes money. That's real wealth. And you're building relationships with international wealth managers, private bankers in Switzerland, Singapore, Luxembourg. Because when crises hit, the people with the best information, the best access, the best deal flow, they survive and thrive. It's not what you know, it's who you know, and who knows you. Tier 5, $50 million and above. At this level, you're not worried about collapse. You're positioning for the rebuild. You're buying distressed assets in bulk. Farmland, commercial real estate, entire companies. When the market crashes, you're the one with cash, buying everything at 20 cents on the dollar. You're funding think tanks, political campaigns, lobbying efforts. Because at this level, you don't just react to policy, you influence it. The rules get written to benefit people like you. That's not conspiracy. That's how the system works. And you're creating generational wealth structures, dynastic trusts, offshore entities that last 100 plus years. Because you're not thinking about the next 10 years. You're thinking about the next century. Let me be very clear. I'm not a financial advisor, and I am not saying any of this is morally right too. I'm telling you what's happening. The game is rigged in favor of people with capital, with access, with knowledge. If you're starting with $5,000, you're playing a different game than someone starting with $5 million. That's reality. But here's what levels the playing field, at least partially: knowledge. The person who knows the collapse is coming has a 6 to 12 month head start on the person who doesn't. The person who understands how currency debasement works can protect themselves. The person who sees the insider exits can make better decisions about their own portfolio. You don't need $50 million to survive a collapse. You need information. You need a plan. And you need to act before the crowd realizes what's happening. Remember the window mentioned at the beginning? Every collapse has one. It's the period between when the insiders start exiting and when the public figures it out. It's usually 6 to 18 months. In 2007, investment banks were selling mortgage-backed securities to pension funds while their own traders were shorting the same assets. The window was about 12 months. By the time Lehman collapsed in September 2008, the insiders had already repositioned. We're in the window right now. The exit started in early 2024. Billionaire stock sales. Central banks buying gold. The dollar losing reserve share. Debt to GDP crossing 121%. These aren't coincidences. They're signals. The question is, what are you going to do with that information? If you do nothing, you'll ride the collapse like everyone else. Your 401k will get cut in half. Your savings will lose purchasing power. Your job might disappear. And when it's over, you'll be poorer. Not because you were lazy or stupid, because you didn't see it coming, But if you act now, if you build liquidity, diversify your assets, stress test your income, get access to foreign accounts and currencies, you'll be in the small percentage of people who not only survive, but come out ahead. Because here's the final secret. Collapses don't destroy wealth. They transfer it. From people who didn't see it coming to people who did. From people who trusted the system to people who understood how the system works. Every collapse creates the same opportunity. Rome, Britain, Weimar Germany, Argentina, Venezuela. The pattern is identical. The question is whether you're going to be on the right side of it. The trigger is already in motion. The debt can't be repaid. The insiders are exiting. The confidence is cracking. What comes next isn't speculation. It's math. And the math doesn't care whether you believe it or not. If this video showed you something you didn't know, if it gave you even one actionable idea, subscribe. Because I'm going to keep tracking the signals. I'm going to keep showing you what the insiders are doing, where the money is moving, what the data says. I'm Malcolm. This is History Meets Economics. And I'll see you in the next one.